Thanks for having me. After the recent crisis, many have blamed Fed actions as causes of the crisis, like loose monetary policy. Or perhaps they point to the problem of the resolution of the crisis, like Fed lending to insolvent institutions. Calls for Fed reform accordingly seek to address those problems. While I don't blame the existence of the Fed itself for the crisis, I believe the Fed, FDIC, and OCC played an important and often overlooked role in engineering the crisis through the seemingly innocuous rule change called the Recourse Rule, which was finalized on November 29, 2001, effective as of January 1st, 2002, although you could get a jump start if you wanted from the day of the finalized rule. The Recourse Rule did to capital requirements what Basel II, for the most part, was going to do. So even though we never adopted Basel II capital adequacy standards in the U.S., effectively by adopting the Recourse Rule or finalizing the rule, we did. So so how is that causing a problem? The Recourse Rule specified that private label asset-backed securitizations, things like ABS, MBS, CDOs, collateralized debt obligations, all of these acronyms that we heard throughout the financial crisis, there was a huge increase in the origination of these securities. So the Recourse Rule, which previously treated standard commercial loans with an 8% capital charge, what that means is banks had to have 8% capital to back an asset holding like that. But under the Recourse Rule, if you now held an A-rated security, you could drop your capital charge to 4%. And if it was AAA or AA rated, you could drop that capital charge to lower to 1.6%. We saw an explosion of AAA rated and AA rated security originations, especially with CDOs, which topped out at something like $1 trillion. I think 700 billion in the structured finance industry itself. And often those securities had liabilities that were 70 or 80% rated as AAA, even though the underlying collateral might have been only triple B rated. I think this rule single-handedly explains why we had a financial crisis, because the rule change stimulated the demand by banks to hold CDOs as well as private label mortgage-backed securities. This in turn spread insolvency risk throughout the financial system, especially the banking system. Insurance companies also had incentives to adopt or use these securities because they could benefit from lower capital charges as well. So even though the Recourse Rule did not affect insurance companies, the insurance industry was following similar principles. Without the Recourse Rule, the demand for CDOs and underlying private label mortgage-backed securities would have been very different, much lower. And large commercial bank and investment bankers would not have been looking so hard to find risky loans to originate to subprime and Alt-A borrowers. So what are my key principles? Well, rather than continue with Basel-type capital adequacy standards, if we're really serious about bank stability, and more importantly, not making taxpayers foot the bill every time there's a crisis for another bailout, then why don't we just simplify capital requirements and raise capital requirements? That could, in terms of simpler capital requirements, that could be just having rules whereby banks must fund, their capital must be comprised of just long-term debt and equity. And there are a number of proposals out there for raising capital requirements. The reason for doing that is simply higher capital means you have a safer bank. Another idea would be maybe you want to remove the rulemaking and supervision role that the Fed plays in the banking system. Maybe we could have a single financial regulator, not 2 or 3 regulators for every part of the financial system, or at least for some parts of the financial system. We seem to have overlapping regulators. The taxpayer could use a break. So maybe something like the OSFI in Canada. So I think I'll conclude my statements with that, and I'll pass it on to Hester first.